안녕하세요. 연말이 다가오면서 투자 포트폴리오를 한 번씩 돌아보고 있으실 것 같은데요. 특히 작년부터 올해까지 기술주 종목들이 시장을 뜨겁게 달구면서 많은 분들이 투자를 하시고 있고, 저희 에이스 ETF에서도 다양한 투자 상품 라인업을 이에 맞춰서 선보이기도 했습니다. 이미 투자를 하셨다면 앞으로 어떻게 전략적으로 이 포지션을 가져가면 좋을지에 대한 고민이 있으실 테고, 또 아직 투자를 못하신 분들이라면 어떤 관점에서 이 테크 투자를 바라보아야 할지 알아보는 시간을 마련했는데요. 이를 위해서 오늘 특별한 게스트를 또 모셨습니다. 바로 기술주 투자 절대 원칙의 저자이자 미국의 저명한 테크 애널리스트인 마하니 씨를 모시고 이야기를 오늘 나눠보겠습니다. Hi, thank you, Mahaney, for joining us. Could you maybe elaborate, briefly introduce about yourself to our Korea audience?
Yes, I'm an equities analyst. I work at Evercore, which is an investment bank that's headquartered in New York. I work out of San Francisco, and I've been covering internet stocks for almost 30 years at different banks, and I've covered tech and growth stocks that include Amazon, Netflix, Google, Meta, Uber, DoorDash, names like that. So I wrote a book about 2 years ago with some of my key takes, the lessons that I've learned from some correct calls that I've made and some mistakes that I've made in the internet sector covering growth stocks. So I'm probably now one of the oldest internet analysts and maybe tech analysts on Wall Street, but it's a job I've really enjoyed doing.
Wow, 30 years. I mean, that's really amazing. So you must have been witness all the history of the tech stocks, maybe their birth, ups and downs, right? So I think that will bring us a very, very great opportunity to have conversation with you because currently Korea investors, they are very into tech stocks, especially the US tech stocks. And as you know, after a very huge rally for this couple of years, we had a great corrections in August. So there's a lot of volatility in the market right now. So how do you actually see the current market situation?
I think the current market situation is generally favorable for tech stocks. I think it's likely that interest rates come down, or at least, what really caused the correction in tech stocks 2 years ago in 2022 was the massive ramp up in interest rates. That's well behind us. We've been in a 2-year bull market, particularly for tech stocks, because interest rates started to flatline or they held and then are likely to come down at least a little bit. And then overall economic conditions, I think, are relatively positive. So those two factors, interest rates kind of moderating, overall economic conditions relatively solid. And then there's this AI or Gen AI cycle. And this is the biggest investment phase that I've seen in a while. So when you see companies like Microsoft and Google and Amazon and Meta investing for capital expenditures, over 150 to 200 billion, and these are the most experienced technology companies out there. When they're investing that much into a trend, there's probably something there. And I think you're going to see more and more examples of Gen AI improving products and processes. So those 3 or 4 reasons are why I think the background to tech stocks and the growth stocks, not for all of them, but for many of them, especially for the highest quality companies, I think that background is still relatively positive.
But then, then what kind of things that we have to look for when we are looking into the tech stocks? Because a lot of people say that investing in tech stocks requires a different mindset compared to traditional investing. So what do you see? Which factor do you think is very important when we're looking into tech stocks?
Well, probably more than anything else is growth. And I think I use the word tech and growth stocks interchangeably. Now, I want to be careful here. There are a lot of companies that say they are tech stocks, but aren't really growing. The companies I look at, one is eBay. eBay hasn't shown any growth in 2 years, so I wouldn't consider eBay a successful tech stock, or maybe it's a tech stock, but it's not a successful one. So I look for companies that can sustain, premium revenue growth, 10%, 15%, 20%. 20% companies are especially impressive because if you can find those are companies growing 10 times, 8 times, 7 times faster than global GDP. That's usually a sign that the company or the management team has either a very large market opportunity or a very good competitive position or is very good at product development. It's usually an indicator of something. So that's what investors should be looking for. The ability of companies to sustain premium growth, especially if they can do it at scale. And when you find those companies, you know, I often try to be very patient and I try to be a long-term holder with those names because they're relatively rare. But, you know, when you find them, I think you stick with them.
So revenue growth, not net income. Why is it?
Well, you look at all these things. You look at net income, you look at margin trends, you look at the balance sheet, you look at the cash flow. But if I'm trying to find something that's different, a successful growth stock, I mean, a successful tech stock, you know, what I'm looking for are companies that can grow earnings faster than other companies because they can grow their top line faster than other companies. There's a lot of different ways you can drive earnings growth. You can buy back stock. You can try to reduce costs and grow your margins. Those are perfectly fine ways to grow earnings. But the most interesting way, I think, to grow earnings if you do it through revenue growth, because that's in many ways that's the hardest way to grow earnings because you know you've got money from customers. You've got to give them a product that they are really excited about and maybe they're willing to pay more for. That's a sign of a successful growth company. And then on top of that, if they can grow their revenue relatively quickly and expand margins and buy back stock, you know, it's a very nice combination. And you're starting to see mature tech companies like a Google, like a Meta, like a Microsoft do that. But they still give you that premium revenue growth. When all is said and done this year, from a very large base, you're going to have 10 to 15% revenue growth from Google. You're going to have 20% revenue growth from Meta. And Meta is doing well over $100 billion a year in revenue. So that to me, that's a growth stock. That's a tech stock. And it's not a cyclical stock. I know there are companies that can, you know, will, as the economy contracts, their growth disappears and then they cycle back up. I'm talking about consistently being able to grow revenue at premium growth rates. That's unusual. And I find that the market is usually willing to, because they're rare, those kind of financials or fundamentals are rare, investors are oftentimes willing to pay a premium for those. And some of those stocks, I mean, if you look at the last 5 to 10 years, some of the, I know there are other stocks. I know there's some value stocks that have done very well over the last 5 to 10 years. But I'm very certain that amongst the best performing stocks over a 2, 5, and 10-year period have been growth stocks, have been tech stocks. It's Microsoft, it's Netflix, it's Google, it's Amazon. These companies and NVIDIA too. I don't cover NVIDIA, but obviously that's one of them.
I mean, there was one interesting point in your book that when tech stocks starts to pay dividend, it's important that you have to kind of watch out. And that was kind of not shocking, but it was impressive to me because a lot of investors, like dividend share buybacks, those are considered to be a very positive signal to traditional value investing. So can you elaborate why tech stock investors should see this differently?
Well, it depends. It depends why they're buying that, why they're paying out a dividend, why they're buying back stock. There are certainly situations, I've seen some tech companies wait too long to pay a dividend, to buy back a stock. I thought Google held an excess amount of cash for too many years. So it just depends on where the company is in the life cycle. If it's a very early stage company, they shouldn't be buying back stock. They shouldn't be paying a dividend. As they get more mature, they should. And the valuation frameworks change. So I want to be clear here. I don't have anything against dividends and share buybacks. And if growth or companies have excess amounts of cash, they absolutely should buy back stock and they should pay a dividend. I don't think growth investors, there are a lot of different companies that pay a dividend and buy back stock. That doesn't really make you that unique. It's the right thing to do at times, but it doesn't make you unique. What's more rare for me it's kind of like the basic economics of supply and demand. There's a very limited number of companies that can sustain premium growth, 10% year in and year out, not just through cycles, but consistently 20%. And a few of these companies have done wonderfully. Look at the companies that created the most market wealth over the last 10, 15 years. It was Apple, Amazon, Google were three of those. And that's because for 10 years, they sustained 20% growth year in and year out from positions of scale. Like they had 25 billion in revenue and they still did 20% revenue growth. Amazing. And the stocks worked phenomenally well during that period. So that's what's more interesting to me. I can find plenty of companies that buy back stock. I can find plenty of companies that pay a dividend. It's much harder to find companies that can sustainably grow revenues at premium levels. Those are very rare assets, and they can be, if you catch them right, they can be enormous wealth creators.
I mean, you keep like highlighting the growth. The growth is the most, I think, the crucial part when you're analyzing tech stocks. But then, then do you have to watch out if the growth kind of slows down? But then what if, like, for a bit like Netflix, like they have a huge subscriber, they're already collecting a lot of cash, but whenever there's like a slowdown in the growth rate of the subscriber, it's a very negative catalyst for the Netflix stock price. But isn't it okay? Aren't they just having solid business? Can we look at it in that way? Or?
Yeah, you can look at it that way. You've also seen when the growth slowed materially. If you pull up a stock price chart on Netflix, I think there's like 3 lessons if you go back over the last 10 years. Netflix was the single best performing S&P 500 of the last decade. S&P 500 stock of the last decade, roughly. It was one of the top performers, but I think it was the single best performer. And that's because it sustained for something like 8 years, 30 to 40% revenue growth. And from a high level, like they were already generating billions in revenue and they sustained that growth. That was truly impressive. And that's why the stock did so well, even though they weren't profitable. In fact, their losses rose. Their losses got worse. Their free cash flow got worse during that period. But the revenue growth was so impressive that the market was willing to be long-term patient about it and say, eventually, this business is going to generate a lot of free cash flow. By the way, they are today. They're generating more free cash flow than any other media company in the world. Now, so that's one part of the Netflix story. The first investing lesson is if you can find a company that can sustain premium growth 20, 30% for multiple years, that's usually a great place to invest. And then the risk you just raised came up. In 2020, they had a huge surge in subscribers and revenue because of COVID. But then they went into 21, and in the beginning of 22, their growth slowed dramatically, and the stock collapsed. The stock corrected about 70 or 80%. It was terrible. And so did Meta, by the way. So these stocks, there's no guarantee here. If the growth slows, if the company has a high multiple and the growth slows dramatically, there's an enormous amount of downside risk to the stock. Absolutely. And that's the second story from Netflix. Then if you see a stock that's where its growth rate is sharply declining, they went to single-digit revenue percent growth, and it's a high multiple. That stock could dramatically underperform. But there's a third story from Netflix. Then they came in. They made 2 major changes to their business model. They started introducing advertising. And then they also started managing paid sharing accounts. Those 2 initiatives, also a consolidation in the rest of the industry, led to the re-acceleration in revenue growth at Netflix. And the stock came back, regained its pre-COVID levels or 2021 levels, and then moved even higher. Like there's 3 sort of stories in there. But I think so much of it really comes down to the growth. When the growth stayed at a premium level, a great stock. When the growth sharply decelerated, terrible stock. And then when the growth re-accelerated, great stock. To me, what you hear as a growth investor is you're making a bet on the sustainability of the top line growth, or whether you think it's going to decelerate sharply or accelerate sharply.
Great. I mean, very straightforward. I think it's a very straightforward story. We discussed that growth is very important, the revenue especially are the key factor. Then if a company has a very strong fundamentals, like there's no need to be overly concerned about short-term price fluctuations. How do you see?
Well, there's always going to be volatility in the market, whether it's because of extraneous shocks like COVID or China supply challenges or elections or, what have you. They'll always have those imbalances, which you're waiting for. For long-term investors, if you have a good asset, you want to kind of stick with it. The more active you are as an investor, you can use those fluctuations to figure out when to add to stocks and when to buy more. And I particularly like this concept I came up with in my book called DHQ, or dislocated high quality companies. And so what I'm trying to strongly recommend for my almost 30 years of looking at tech stocks, you want to identify the highest quality names and then wait for them to get dislocated, to sell off 20 or 30%, because every single high quality stock I've seen, no matter how good the company is, whether it's Microsoft, an NVIDIA, an Intel, no matter how good the company is, invariably there's some sort of a sell-off because of usually a market condition. Companies make mistakes. And the real key is knowing which of those corrections to step in and buy. That's what I really try to do. Identify the high quality companies. I'm not trying to buy cheap, low quality companies. I don't recommend doing that. I recommend finding high quality companies and buy them when they're dislocated. And there's an old expression that well. It's buy low, sell high. And I kind of changed it a little bit. And I say I want to buy high, low. So I want to buy high quality companies when they're at a low price. I know that. That's an easy thing to say. It's a hard thing to identify, but I look for these opportunities. We've had several opportunities just in the market this year. Google getting corrected down to 130 over concerns over generative AI. Uber trading off aggressively earlier this year over concerns over robo-taxis. So these corrections happen a lot. You just have to really do your work to decide what's a high quality company, one that I'm going to be looking for opportunities to buy on corrections.
Yes. But for normal most investors, we know that the equity market is very volatile, and also the tech stocks can tend to, fall significantly. But then it's really painful to endure those bearish times for most investors, right? So I think it's good for us to know that why is these, even strong companies, stock prices, why do they still can fall significantly, like 30 or 40%?
Well, they can fall in part due to market conditions. We had a dramatic sell-off in the first part of 2022. So that's just 2 years ago. The tech stocks traded off as a basket close to 50%. And that was because of a dramatic rise in interest rates. That created, by the way, a wonderful DHQ opportunity. So if you had identified high quality companies, it's impossible to call the bottom. But when that stock, another way I try to think about this is when I'm in the market, I'm trying to mitigate, there's always risk. I'm trying to mitigate two types of risk. I want to mitigate fundamentals risk and valuation risk. Fundamentals risk is, the risk that a company misses a quarter, its growth slows down dramatically, it loses market share to a competitor, they overspend on a marketing campaign. All of those I call kind of fundamental financial risks. You want to mitigate those, and the way to do that is to look for a track record of company outperformance. Look for high quality companies that are very good at product innovation, that have a track record of doing that, companies that are sustaining high revenue growth, because it's hard to do that. So if you see a company that's able to sustain a couple of years of high revenue growth, 10, 15, 20%, there's something in the culture or the opportunity that you want to probably invest in. So you mitigate the fundamental risk by finding the high quality companies. Then the other risk is the valuation risk. And that's the risk of buying a stock at 50 times PE and then 2 years later finding it that it's a 20 times PE. That's a lot of risk. That's valuation risk. But one of the ways you can mitigate that is wait for any stock to correct. And I'm just going to make the point that I've seen, no matter how high quality the company is, these stocks correct from time to time for market conditions, sector conditions, or even company-specific conditions. And they don't always get every quarter right. But the question is, the challenge is, if you can look at those corrections sometimes not as opportunities, because you've been watching this company for a while, you've been watching the stock, you really believe in it, you've seen the correction in the stock, maybe it's time to step in and buy. Do your homework to mitigate the fundamental risk by identifying high quality companies. That's what I tried to go through in my book, how to identify the high quality companies, and then wait for a dislocation. Wait for the stock to trade off 20 or 30%, and then use that as an opportunity to start buying some of the shares of the companies that you like.
So, having observed the market for the last 30 years, 30%, 40% drop, it's something that's not unusual thing. Can you phrase it that way, or?
Yeah, I know 30 to 40% is pretty that's a little bit unusual, in that standard deviation. That's a few steps out, but to see 10 or 20% corrections, I think that's much more normal. So my trigger is really kind of a 20% correction. To me, that's a stock that's dislocated and maybe one I want to step in on. 30 to 40% is actually more on the rare side, but I've seen it, and we had this in the beginning of 22, and I can come up with a scenario under which stocks could correct again if you had a resurgence in inflation and the Federal Reserve had to change and start raising rates again, and you had some sort of economic catalyst, negative economic catalyst, a major trade issue or a trade war or something like that, and which started affecting trading relations and exports and imports. Yeah, then I could see a situation like that where you could see a major trade-off in the market. It'd be hard to see a 40% correction, but it's possible. We should be, in the next 3 years, I think the chances that you and I are going to see a 10 to 20% correction in the market, I think that's reasonably high. I think it's probably greater than a 50% chance. The question will be what happens after that. But the chances of us having that kind of correction, I think, are reasonably high.
Yes, because a lot of our investors, they started investing in stocks in the bull market. For some of them, these market, correction situation is like the first time they see it. So they kind of freak out because it falls down and they kind of think they will never come up again. So I just wanted to give message to our investors that these happens, and if you kind of endure this hardish time and you're investing in the right company, you could enjoy the fruitful outcome maybe. So that's the message that I wanted to share.
Yeah, I think your message is correct, and it's what I've lived through. I've covered arguably one of the most volatile sectors on Wall Street over the last 25 years, 30 years. Internet stocks have been very volatile. There was the dot-com boom, the dot-com bust. There were beliefs that companies like Amazon would never be profitable. Netflix was going to get beaten by Disney. I mean, if you can own a handful of these stocks, they've been phenomenal outperformers. But it's a matter of identifying the right companies and then just being patient and also expecting their chances are you're going to have a 10 to 20% correction, in the market over the next 3 years. I'd be surprised if we didn't. I don't know if it'll be a long correction or a short correction, but that should give you an opportunity to buy more shares of high quality companies. And at the end of the day, there's a lot you can't really control about the valuation risk because there's so many things that can shock the market. By the way, to the positive too. But one of the best ways you can control your financial future is to invest with the highest quality companies out there. Don't just buy cheap stocks because they're cheap. Oftentimes, my history with tech stocks has generally been stocks got cheap for a very good reason, and I think you get more wins, you make more money buying the highest quality stocks, even at times they look expensive.
I mean, Thank you so much for your sharing insights today. So we're inviting Mr. Mahaney to Korea to share deeper insights with our investors this December. So what can investor could look forward to hear, Mahaney?
Well, I'll talk a little bit about my book. This will be my 4th trip to Korea. And I'll be talking about some of the ideas that you and I just spoke with. But I hope to share some of the lessons that I've drawn from almost 30 years of investing in this space.
Okay, great. Thank you again, Mark, for joining us today. I'm sure our viewers have gained a lot from this conversation, and we really look forward to see you in Korea this December.
And I look forward to my visit to Seoul, and I hope to meet everybody soon. I'm very excited about the trip, so I very much appreciate you bringing me on the trip. 감사합니다.
방금 마하니 씨가 말씀하신 DHQ, 한국어로는 이탈한 우량주로 번역이 되어 있는데 앞서 논의한 바와 같이 모든 것이 갖추어진 우량주도 이탈, 즉 주가 조정은 늘 일어나기 마련입니다. 경험상 모든 우량주는 언젠가는 이탈하는 순간이 있으며 이는 인내심 많은 장기 투자자들에게는 엄청난 기회를 제공한다고 저자는 말하고 있는데요. 조금 더 자세한 이야기가 궁금하신 분들은 저희 12월에 있을 투자 세미나에 참석해 주시면 되고요. 이를 위한 이벤트도 함께 진행 중이니까 많은 참여 부탁드립니다. 감사합니다.